So hi everyone, good afternoon. So I'm Vishwanath. I'm going to be your faculty for this training program on project finance. Some of you, I could see your name. Some of you probably also attended the program yesterday on investment banking. So yeah, great to see you today as well. I'll just briefly introduce myself and then I'll set the agenda for the training, and post that I'll start with the session. Just one second. Yeah. So in terms of, just to introduce myself, so I'm a chartered accountant with around 16 years of experience, of which ample amount of time has been spent on training. So I started my career with Ford Motors, then I moved to equity research, then I moved into consulting role. And I was with Citigroup as their internal trainer in 2012. So 2015, I left Citi and I started on my own. I had started my consulting career along with training. And since 2015, I've conducted training programs for a lot of corporates and students across the world, mainly, of course, in India, Southeast Asia, Middle East, and a bit of Africa. Yeah, not much outside of this zone. So that's about myself in brief. And now just to give you a set of, help you understand in terms of, the course curriculum. I'll just set your expectations, what we are going to be covering here. You would have already gone through it, but just to quickly take you through that, I will. Oh, I'm glad. I think I'm also seeing participants who attended my other programs. Really glad to see you all here. Let me share the screen. So what we're going to be doing is, today our agenda is going to be about trying to understand what is project finance, right? How is it different from, let's say, anything else? And typically, how is a project funded and structured? That is what we're going to understand today. And gradually, we'll be moving into talking about, what are the source of funding that is available for a project, right? For a PPP project, what kind of fundings are available? If you're talking about non-PPP projects, private sector projects, what kind of sources are available? Who are the various players who come in here? And how are transactions typically structured? What are the various instruments that we use here? Right? How do we protect the interest of, let's say, a subordinate lender or a private equity player who comes in and gives the money, a financial investor? How do we look at them? So this is something we'll be learning. And after spending some time on that, we will talk about financial metrics, right? When you're analyzing a project, how do you financially do an appraisal? How do you test the financial feasibility of a project? Here we'll talk about concepts such as NPV, IRR, MIRR, what are their fundamentals there. We will also talk about in terms of, how do you price for a bid? So if it's a solar project and somebody is asking, maybe a company wants, you're a solar power company and somebody wants you to set up a solar power plant and build them. How do you go for bidding? So we will understand those things, those nuances. Once we understand this, so first 5 sessions, we're going to be spending understanding the fundamentals. Once we understand these first 5 sessions are gone, last 5 sessions, we're going to be spending predominantly on financial modeling for project finance. How do you do a fundamental financial feasibility study of a project? By looking at by building a financial model. Of course, one of the things is, in real life, if you were to build a model for a project, do a financial feasibility with all the complexities in place, it would take you at least a week. So in 10 hours, total of 10 hours in a training environment, you cannot do it absolutely on a real life level. But what we would be doing is, we will try to build it with all complexities that you typically would face. We'll try to bring in all those things, but we'll shrink the problem so that it fits into a training, into a 10-hour training program. So only thing is, in real life here, if I talk about, let's say, a project having 3 parts, in real life, you'll have 300 parts. That is where the extra time goes in. But whatever you apply in the 3 parts, you can easily apply in the 300 parts. So that is how the financial modeling part is going to be. So that's just to set the agenda in terms of, how the 20 hours we're going to be spending it. Any questions, any thoughts? Okay. All right. Fantastic. So if you have any questions or anything, feel free to put them on the comment section, and you can raise your questions. Now let's get started with our discussion. Just give me one moment. Let me open I'm slightly worried about whiteboard. I'll open Paintbrush. I'll not, I'll send you the PPTs, but I'll not use PPT in the class for now. We'll talk about PPTs later. I prefer to work with pen and paper in the class and Excel, of course, right? So we'll start with this. Let me also switch off my camera. I'll just switch off my screen here, right? Oh, sorry. I also, by mistake, I muted myself. Sorry. Yeah. Great. So we are going to talk about first thing, what is a project finance, right? First, let's talk about what is a project. If I talk about project, what would we mean by a project? Let's try to understand that first. And once we understand the project, then we'll talk about how are these projects structured and where does the project finance concept come in. So if somebody says project, what is in general a project, right? And the reason I'm talking about this is project finance have different meaning in different context. Just 1 second. I'm using my audio quality to the best of its level. So just check, because I just got a comment that audio needs to be increased. It already seems to be pretty robust. Can anyone confirm if the audio is fine or if it's too feeble? Okay, great. All right, fantastic. Then let me continue. Thank you. So why I'm starting with the meaning of project finance is because the term project finance means different thing in different contexts. So if you go to a software company, when somebody says that I'm working in project finance, what they are trying to do is they are trying to quantify the cost of a project. They try to control the budget for a particular project. So I'm developing, let's say I'm implementing SAP for a company. So here we are just going to sit and figure out, what would be the cost of that implementation, how many project managers are required, how many people are required, how many people have to travel, what would be the travel cost. And they prepare the budget and then they look at the actuals. That's all they do. That's called project finance for them. In our context, when we say project finance, what do we mean by that? So first, let's understand what's a project. In general, when we say project, we are talking about anything that has a finite timelines, right? Anything to be completed in finite timelines, we would call it as a project, right? Now, when here we are talking about project, we are essentially talking about two kinds of projects in a project finance context. Our two things that we are talking about are infrastructure project and real estate projects. For us, we are only talking about these two things, right? We are not bothered about all projects. We are not bothered about software projects. We are not talking about anything. In project finance, when we are talking about real estate projects and we are talking about infrastructure projects. Now, within infra projects and real estate projects, if you look at it, not all projects are talked as project finance, not funding for all the projects. So by project finance, we're talking about raising funds for a project. That is what we call as project finance. Now, within infrastructure projects, if you look at it, how these projects are modeled, there are various levels. There are various business models that are there. On one extreme is a pure EPC. And on the other, EPC stands for engineering, procurement, and construction. On the other is BOOT, right? Now, what is EPC model basically? In an EPC model, essentially what is going to happen is, I am going to construct, I'm going to do, if let's say, for example, I'm being given a task to construct a bridge across a railway line, right? Now I have to do the design and engineering of it, where will, figure out how many pillars would be there, where will it start, where will it end, what will be the width of the road, what should be the width of the pillar. I take care of all the engineering aspect, right? I take care of procuring. So I figure out what is to be constructed, how it is to be constructed. I procure the necessary materials, men and machinery, right? How many laborers are required, what materials are required. I figure out all those things. I procure them. I construct this. I get it done. right? This is project management, right? This is EPC all put together. Now, within this, sometimes if you look at it in real life, if you look at it, there could be some cases where somebody is only taking care of the construction part. I have somebody who was given the engineering, design and everything, and the project owner, whoever is the owner, if any of you have seen a house construction in any suburbs, probably you will have it. An engineer does the engineering part. Then it's the owner's job to procure everything. And you will have the mason or some senior guy who will only take care of supervision and construction, right? So in a pure EPC, a lot of time in infrastructure projects, it's all three are handled by one person. So this is a pure EPC. One person takes care of all the three. In these projects, how are people funded? More than how are people funded? How does the commercial work, right? The way the commercial works is, let's say if Mumbai municipality is asking me to construct this bridge, or let's say Hyderabad municipality wants me to construct this bridge, I would apply a tender. In the tender, they will give it to whoever is quoting the lowest amount, right? Whoever says, I'll take the lowest amount, they will give the project to them. That person may subcontract this part. They may say, okay, you know what? I will do the engineering and procurement. Construction, I'll outsource it to somebody else, right? Can happen. It can happen, or somebody may say, I'll do it myself. So L&T won the bid, but L&T gives the construction work to somebody else. Can happen, very well happen. Quite common, these are, right? Now, but within this, when you're constructing the bridge, what will happen is, let's say I constructed part of the bridge, right? 30% work is done. Now, when 30% work is done, maybe I'll bill the municipality for this. I'll bill municipality for 20% of the billing, right? Then I finish some more part of the bridge, 50% work is done. Then I'll put another 20%. So 20 plus 20, 40% I bill the municipality. Then I finish 100% or 60% I finish, or 75% I finish. Then another 20% billing I do. 100% I finish, I do another 20% billing. Then some engineer comes to supervision and gives the approval, and I do another 20% billing. Right? This is how typically a municipal project is going to work. Now, in this case, if you look at it, as a construction company, for me, what are the risks that I am taking? My risk is I finish the project, then I have to collect money from the customer, right? I have to go and collect this 20% money after doing this 30%. If I finish 50%, I have to collect this 20. So I bill the customer has to pay me. In government and all, getting money from government department is not an easy task. It takes 6 months, 1 year time sometimes, right? So getting this money could be time consuming. So this is one part of the thing. This is one credit risk, you may say. Not really credit risk, but as much as about the delay in collecting the money. What would happen? Let's say I finish the project 50%, and at this juncture, somebody files the stay. So there is a building owner in this area, and the building owner puts a stay saying that I will not let the project go through, right? You cannot demolish my building. Goes to the court and gets a stay here. Doesn't agree to vacate. So bridge cannot land. Now, as a construction company, what happens to you? What happens to you is there is a 10% you have done extra work which you can't bill, because municipality says you bill me after 75%. But you have at least recovered this 40% money has come to your pocket, right? And keep in mind this 40% is with margin. So that means if my cost was 600 here, so if the total cost of the project was, let's say, 1,000 crores, and my total bid was 1,500 crores. So I finished 30% of the work, and I would have spent 300, and I would have billed 300, because I'm going to bill 1,500 into 20%. Similarly, when I finish 50% of the work, I have total spent 500. Now, if I'm going to do 1,500 times 40%, it's 600. So I'm still making some money, right? Until the stay is lifted, until the project is released. Of course, I cannot complete the balance project, and which means my revenue is going, there's going to be a loss of profit. Maybe some loss could also be there. But overall, I would have, the risk is not as big as this, right? The risk here is in the municipality's problem. If this court case doesn't get over, municipality has spent money on 600 crores, they have paid me, and they don't have a bridge ready yet. It is their problem, not mine, right? I have my problem is much smaller compared to that. Is it clear? Any questions? Okay. Now let's go to the other spectrum, a completely other spectrum of project, which is we are talking about as BOOT project. What does BOOT stand for? BOOT stands for build, own, operate, and transfer. Right? Build, own, operate, transfer. Now they also have various other terms. DBOOT, which means design, build, own, operate, transfer. Then DF boot, you design, you fund, you build, you own, you operate, you transfer. But core is boot, right? Sometimes the T element is not there. It is only BOO, no T at all. So what is this model of construction project? So if we talk about some toll roads, highways, you notice, in case of these highways or airports, so I am constructing this highway, right? I am constructing this entire highway across a huge length. Now, what does government pay me for this? If you look at it, maybe nothing. Government doesn't pay anything. I am building this road and I get paid nothing. Or I'm constructing the airport, government doesn't pay me anything. Then how do I recover the money? So I built this road. I'm going to be the owner and operator of this road. So I'm going to set up a toll plazas here and there. And every time a vehicle goes, they pay me the toll money, right? Every time they cross the toll plaza, they're going to pay me for the toll charges. And this is how I'm going to recover my cost of constructing the project. This model, we call it as the BOOT model, build, own, operate, transfer model. So what is the transfer path? So probably what will happen is government will give me a concession for, let's say 30 months or so, 30 years or so, which means for 30 years, whatever toll charges I collect, it's my money. At the end of 30th year, this project will be handed over to the government. Then government may either remove the toll from this, or government may start collecting the toll on its own. So government may collect the toll and put it in its pocket. So the private player will not exist. This is what we call as build, own, operate, transfer model. Right? So in a build, own, operate, transfer model, let's talk about the risk that is involved. Let us say I'm constructing this road, right? I've got people to construct the road here. And what I'm going to do is somewhere in between, it has to go through a village. And in this village, a bunch of, some politicians and some bunch of people come and do a dharna. They say, you know what, we will not let you do the work here. This affects our ecology. This affects our economy, whatever. Now what happens? I have finished the bridge. I've finished most of the work, right? 70-80% of the work is done. Now, right now, there are people who are protesting against this. I cannot finish this part. And unless I finish this part, I cannot open the road, right? I cannot open the road and say, half the road is done, pay me half the money. And government is not paying me, keep in mind. Now, people are protesting. I cannot finish the work. Bank is charging the interest rate because the clock is ticking for the bank, right? So bank is charging me the interest rate. I cannot let the vehicles pass. What is going to happen to me as a business? Whatever I have spent here, I'm going to lose the entire money, right? Whatever crores of, I might have spent like, let's say 8,000 crores till date on this bridge, or I might have spent 4,000 crores. Not a single rupee is going to come until I can pacify these protesters, right? Until I can somehow get them off. Okay, one question I have is, do government have any termination right at any time? There are certain clauses that can go into BOOT contracts. We will talk about the typical model contract of a BOOT. We'll talk about that. When I go to that, I'll address these questions. Right? For now, I'm just giving you a broad idea about how BOOT works. Okay. So under these sections, what is going to happen is, who's going to bear the risk? The entire risk is going to be on the heads of the construction company. Right? So here is where we talk about project financing. So the idea is, how do I fund this project? Because it is risk for everybody, right? If I'm going to put a capital, it's risk for me. My work may not get over. If a bank is going to give a loan, it is a risk for them. Until this project is done, I don't know what is going to happen. And even if a bank is going to give me a loan, I'll in fact come to the financing side of it later. So this is another model. Clear? Any questions here? And this is a small trivia actually, if I have to add. Sometimes, in some places you may see a very small political party which has which never contest an election. They have nothing to do. And you will see these political parties there. How do they make money? This is their business model, right? This is pretty much their business model. What they would do is they'll figure out with their bunch of people, they'll go and create problems for projects so that you can harm twist the project sponsoring company, whoever it is, to pay you off. You can tell them, you pay me off, I'll withdraw the agitation. Otherwise, you are going to bleed it on interest. So that's just a small trivia. Now, are these clearances government responsibility? Not really, right? It is really not as much a government's problem. I mean, government will help you. Government will try to help you because it is government's project. But until the project gets over, where is the interest going out? Interest is going out from your pocket. At the end of the day, government will say, I'll help you out on these things, right? But literally, I mean, until if there is a problem, you finished most part of it, interest, you are bleeding interest. And government will say, we are speaking and everything. So the loss is for you, right? And one thing a government may tell you is they may give you some concession. They may say, okay, you know what, you face some problem, we know it. So instead of 30 years, I'll give you right to operate it for 35 years. You incurred some extra interest loss. So I'll extend the time period by 5 years. Take it. That's what sometimes government do to help people out. Okay. Now coming back to this. So this is boot model. Now in India, if you look at it, boot model, we first initiated this sometime in 1999. To the best of my knowledge, the Noida-Delhi toll road. So there's a toll road from Delhi Ashram, I mean, from Ashram towards Noida. That toll road, it also connects some part of Mayur Vihar or some other parts of Delhi, basically. That toll road is the first project that happened in the boot model. And since then, we took a lot of boot project, because in boot project, what is the base? I'm talking about boot in a PPP project. PPP stands for public-private partnerships. So in boot project, what is the best thing for a government if you think of it? What works very well for the government is government doesn't pay money, right? It's an infrastructure project, but government doesn't pay money out of its pocket. Somebody puts their money and constructs the road, right? Now, in that case, what happens is you will typically have, I mean, that means I can undertake a lot of infrastructure project without hitting the budget deficit, right? So when a government prepares a budget, I can roll out plans for thousands of kilometers of road. Not a single rupee will hit my budget because I'm not paying for it. Somebody else is paying for it, right? So boot project gained a lot of prominence. Okay, I've got one good question, that even after project completion, there can be risk. You're absolutely right. You're absolutely right. Even after project completion, there is a risk. I'll talk about the risk element a little bit more detailed once I complete other models. What are the other models of infrastructure project? On one spectrum, we are talking about EPC. On the other hand, we are talking about boot. And what are the others that are there in between? I'll come to it. But just one moment. So what essentially happened was that, between 2000 to 2007 or so, you had government just went doing a lots of infrastructure projects. Way too many infrastructure projects happened on the boot basis. And that's why you would have seen that, during that period, a lot of expansion happened, a lot of toll roads, highways, so many things came because you could do it without spending money. But what happened was this: a lot of construction companies started getting into trouble because there were projects that were stuck. There were projects that were stuck because of public. There were projects that were stuck because of government departments. So if you look at it, when this NDA government came, India 1, or I should say India 2 in a way, 2014 when they came, that time one of the allegations that they were keeping on the previous government was that there is a problem between the departments of government itself. Highway department says construct a highway, and environment department says we will not let the highway happen, right? So there were so many problems that happened. Public are agitating, or environment clearance is not happening, or there were some roads, the roads failed. Because at the end of the day, what is going to happen is, if I'm going to construct a road here and tomorrow there is a economic activity doesn't happen, or tomorrow somebody else constructs another road around this, and let's say then not many people may start taking the new road and they may not take this road, right? So I was expecting 10,000 vehicles to pass through, only 3,000 are passing through, others are going through another road. Could happen. So a lot of companies started getting into trouble in the infrastructure space. So what happened because of all these things? The boot model started dying down. Companies did not have the budget to take these projects. They said, you know what, we can't do it. We are running out of money. We are going bankrupt because we have pumped money into constructing the road. We don't have it. Then what government did is, in India, another model that came up was an annuity model. What is an annuity model? See, when you talk about the boot, right now also to address the two kinds of risks that are there in a boot contract. So in an EPC contract, your only problem is finish the construction and get the money paid. That is your only problem, right? In your boot contract, I have to finish the road. That is one problem. Road or airport or anything, metro, anything. I have to finish it. After finishing, it has to be successful. Reliance Infra constructed an airport. Again, I think in Delhi, they connected an airport connecting, metro. They did the metro from some part of Delhi city to Terminal 3. It was a mega flop. Not many people were using that metro. They thought metro would be a very big success. It's a mega flop. So I constructed the metro hoping people would take it, and people didn't take it, right? I'm not able to recover the money. So two risks that are there. One is construction. Another one, commercial. Now, as far as a boot is concerned, both the risks are on your head, right? If it's a boot, finish your construction, that's your problem. Then it has to be commercially successful. That's your problem, right? If it is not commercially successful, company suffers the loss. Okay, one question here is, for both type of project, we should do a proper economic feasibility with stress testing. That goes without saying. For anything you do, you should do it, right? Anything and everything you should do it. But I'll also add some small trivia, which used to be there. I don't know if it is still there, right? How some companies were bidding for it without necessarily doing a financial feasibility, and why they were doing it. I'll talk about that a little later. Now coming to this. So this is one thing. Construction, I have to do on commercial risk. In an annuity model, what government did was they came and said, you know what, commercial risk is not your problem. Don't bother about it. You finish the construction. So here, what is going to happen is you finish the construction, and once construction is done, government will pay fixed amount every year to the operator. They'll say, no, you finish the construction, you own it, right? I mean, you operate the road, you do the maintenance and everything of the road, right? Construction and maintenance is your problem. But once the construction is done, then every year we will pay you, let's say something like 500 crores every year for next 25 years. That is what we will pay you. That is the annuity model. So in the annuity model, what is happening is construction risk is on the company, but commercial risk is on the government, right? Government doesn't, if the project is utter flop, nobody takes the road, the operator doesn't have to bother. Government will pay the operator a fixed amount of money, right? Government may, National Highway Authority Department may come and set up their own toll booth, but any toll collection happens, that goes to NHA or government. The operator only gets a fixed amount every year. This model is called as annuity model. Now, how is the annuity model different from EPC model? So in an EPC model, you can recover a pure EPC model. You can recover your money even you keep doing a part billing, milestone based billing. For every 5 pillars, I'll charge you so much, right? Once I'm going to charge you based on certain milestones. You can charge them. In annuity, that milestone option doesn't exist. You have to finish the road. So which means why government insists on this is for large projects, sometimes what could happen is, there could be a fatigue that may set in here. A fatigue may set in for these guys right here. For the EPC guys, they may say, too many problems. This is taking too much of diverting too much of management attention. So let me give up on this project. That could also happen. Now, We don't want that. Just give me one moment. Yeah, sorry. So what could be happening is in a pure EPC, the fatigue could set in, and sometimes this could happen that the construction company says, okay, you know what, I can't get the balance money, but let's let it go, right? I would rather go to some other project and spend my time. So that can happen. In an annuity, your fatigue cannot set in. I mean, you have to finish your work. Only then you can get money from government. So this ensures that, any project that are started, they don't get until then, I'm not going to pay the construction company. So that is one advantage of an annuity model for the government. What happened here also is these guys started facing problem with construction itself. So annuity model happened in India for a while. We started with boot. Then from boot, we went to annuity. We said, let's do projects on an annuity basis. And we will give the the construction company a fixed amount. Once they finish the project, rather than the revenue depending on the market condition, we will give them a fixed amount for 25 years. During that period, they are also supposed to maintain that asset, road, airport, whatever it is. But annuity also started facing less traction because people are like, I can't even finish construction, and I'm not able to finish the construction because agitations and problem are happening. And by this time, if you look at it, a lot of infra companies in India went through their balance sheet has gone to the dogs. Their balance sheet in such a pathetic state, they are not able to take any risk, and nobody is willing to lend them or do anything here. So government came up with one more model, which is a hybrid annuity model. HAM. HAM stands for hybrid annuity model. It's a hybrid of EPC and annuity. What does we mean by hybrid annuity model? So here what we're going to do is we're going to say, okay, you know what? If you're constructing the road, right? Government will pay you for part of the construction. So you construct the road like what we discussed earlier, right? You're constructing the bridge, whatever. If you finish 30% of it, you bill me 10%. You finish 50%, maybe you bill me another 10%. You finish 75, bill me another 10. You finish 100, bill me another 10. So 40% of your money, you can recover it during the construction itself. So to that extent, it's like the EPC model. And balance will be paid to you every year. So besides this, I'll pay you, let's say, $30 million every year for 10 years. Right? Or if I have to talk in rupee terms, maybe something like 2,000 crores every year for 10 years. This is the hybrid annuity model. As on date, most of the projects that are happening under the hybrid annuity model. That is how projects are getting announced. Is that clear? Now, as far as government is concerned, which type would be the best for government? The best for government would be boot, because, and why is that? I already mentioned that, but can anyone tell me why is that? That's the best thing for government. Exactly. No investment. Not a single rupee goes out of their pocket. No impact on fiscal deficit. No impact on current account deficit. Nothing. Right? Is annuity model useful for government at all? Because they still have to pay sometime in the future. How is that useful for the government? Because they still have to pay. The thing is, you're at least pushing your fiscal deficit problem to the future, right? Government doesn't use any accrual concept of accounting and all, right? Government doesn't use accrual concept accounting. They don't do a provision entry or anything. For them, what is the cash going out, cash coming in? That's all they care. So I can start a project today, cash will have to go out 5 years later. It's a problem for the next government, not for me, right? So annuity model is the next better thing. HAM is what they have to settle for now, because in a ham, they still have to pay some money, which means any project you undertake will hit your fiscal, will hit your budget, and you may not be able to therefore take such a large number of projects that you can undertake if it was on a boot basis. Clear? Any questions here? Okay. Now, moving on, this problem of boot is not just there in PPP projects. PPP stands for public-private project, right? Public-private project is where a public utility like an airport or a seaport or metro station, metros, highways, these are all constructed in partnership with a private entity. But there are also boot models which are purely private, right? Yes, absolutely right. In terms of the risk, what I'm seeing here, I just got this message. EPC is the highest risk, followed by HAM, because here all money is going out, and if project is stuck, money has gone out of government's pocket and people don't see the bridge. So you will neither get owed nor your economics is good. Both are bad. Then comes annuity. Then comes boot. Right? Boot is probably the safest as far as government is concerned. This is from a risk perspective. Now coming to private sector. In private sector, do boots happen? Answer is yes. So in a private sector, what could happen is, let's say, I'm just giving you an example here. I really don't know who's dealing with who, but just let's say, for example, Asian Paints is there. Now, Asian Paint is at the end of the day, it's a chemical company. So they are going to be using a lot of chemicals. Now, somebody needs to treat these chemicals, right? Because all the chemicals that Asian Paints generate, some of them goes into the paint box, comes to the hardware store, and eventually comes to your house. What about the chemicals that are discharged from their plant? That chemical cannot go into the soil or go into the river water. Then they will have to face trouble. These chemicals have to be treated. Now, Asian Paints is an expert in treating chemicals. I mean, in making paints. Asian Paint has no idea about treating chemicals. That's not their expertise. Their expertise is in making paints. Now, what may Asian Paints do? I'm just taking their names for illustration's sake. I really don't know what Asian Paints does here. So what an Asian Paints may do is, they may say, you know what, here is my factory, right? So here is my factory, and next to that, here is a river, right? My chemical needs to go to the river, but not chemical. I mean, the water has to go to the river. I have to discharge it, but I can't send the water as it is because it is impure, filled with chemicals. So we need a water treatment plant, right? We need a plant through which the water can go. And this water can be cleaned up. Then I can send it, discharge it to the soil. I can discharge it inside a lake, anything. But treatment has to happen here. Now, to treat this, I need somebody who has treatment capacity. This entire area is my factory. So what I may do is, I may get a guy like VA Tech or somebody who is a specialist in water treatment plants and chemical treatment plants. I may call them and I may tell them, you know what, you construct this plant inside my factory, right? You operate it, because we don't know to operate chemical treatment plants. You are an expert in chemical treatment. I have no idea about chemical treatment. So you set up the plant, you put your people here, you set the process to treat the whatever contaminated chemicals or water that I'm sending, remove the contamination and send good quality. I mean, and then we can discharge the balance. Now for this, I will pay you on a per liter basis. I'll probably pay you $1 per liter of chemical you treat. Right? This is what I'm going to tell them. I'm going to tell them, you know, I'll pay you $1 per liter of $1, whatever, 100 rupees, whatever. For every liter you treat, I won't pay you a single rupee for setting up the plant. Setting up the plant is your headache. Right? I am giving you in my factory area. This factory area belongs to me. I will let your people come here, construct this. And my people will not interfere in this. But we will not pay a single rupee for setting up this plant. What we will pay you is for the quality of treatment that you're offering us. We will check this water quality. This test has to be good. Right? If I am satisfied with the water that you're treating, Then based on this, I'll give you, for every liter of water traded, I'll give you some money. That is how chemical treatment works here. Right? I mean, this is a boot model. Okay. Any questions? When I said boot can be just BOO, what does that mean? That means Asian Paints may say, you don't even transfer it to me. Forever you can keep this here, right? You can keep it as long as you have it here. You run it and I'll give you $1 per liter every time, right? You don't even have to transfer the plant to me. It's yours, right? This is yours. You do it. Of course, but I'll pay you only on $1 per liter basis, right? If it's boot, then eventually maybe 20 years, 25 years later, you will have to transfer it to my company. So we will, by that time, I will appoint some people who will understand how to operate this plant and everything. I will send some of my people to learn it from you. Then you transfer it to me 25 years later. That is boot. If it is only BOO, then you set up everything, you own and operate. We also have similar models in the power sector. So in a power sector also, what may happen is, again, same thing. Here is a factory. The factory needs a lot of power. And for that, I need power lines to be set up, right? I mean, my drawings are all bad. So a power line needs to be set up. For this, I need somebody to have a power station. So I'm thinking of, rather than going to the government, I think solar power is probably cheaper for me. But I'm a Honda or I'm a Toyota. I don't know how to set up a power station. I know to manufacture a car, right? I need this power to come. So what I do is I go and look at some other person who is an expert in, let's say, a Suzlon or somebody else. So I may tell a Suzlon that, you set up your wind energy plant, right? You set up your wind energy plant and whatever power they generated, you supply to me, I will buy you. I'm going to give you this piece of area near my factory. You set up your plants here, right? You set up all your plants, you run your wind energy, wind turbines. You give me the electricity and I will pay you for that electricity. I'll enter into a power purchase agreement where I'll pay you the dollars. I am not going to pay you for setting up the plant, right? I'm not going to give you money for your wind turbines. That is your cost. You spend that money, right? You spend your money, you set up the turbines and I will pay you only for the dollar. For the current that you're giving me. You give me current, I'll give the money to you, right? Again, an example of a boot model or a BOO model. You build this, you own it, you operate it. How am I going to compensate you for it? Because Suzlon has no reason to come and set it up. Suzlon is setting it up only because Toyota wants it. And how is Toyota going to pay Suzlon? Toyota is going to pay them for every unit, right? Again, as I said, I don't know who has what kind of arrangement with who. I'm just giving this for illustration's sake. Clear? Any questions? All right. So these are all on the infrastructure side. We talked about how projects work, what is boot models, what is EPC, what is HAM, what is annuity. We talked about all these things. Now, very briefly, I'm also going to talk to you about real estate. In real estate, how these things work, right? So in real estate also, if you look at it, very similar things, because these days and all, if you look at it, so let's say in a Bangalore, if a Prestige or a Shobha is going to set up a new society, they are going to construct like 1,000, 2,000 flats in one society. Massive investment, right? I have to buy a large parcel of land, and in this large parcel of land, I'm going to construct probably 5, 6 towers. And in each of these towers, it's all going to be skyscrapers. And I'm going to be incurring large amount of money, right? So what typically happens in these cases is a Shobha may not want to, or a Prestige may not want to construct these apartments all by themselves. So here again, the kind of setup that these guys may do, or a DLF, what they may do is, so a DLF may come here and DLF may say, you know what, I'm the company, I want to take this project, but I can't do this project all on my own. It's too risky for me, right? It requires so much capital, and after pumping in so much capital, if the business flops, my money is gone, right? I can't do anything else until this business comes up. So typically what happens is they get a partner in place. So there could be a Blackstone or somebody else, right? You may have a Blackstone or someone else. they would like to do a partnership here. So what will happen is these guys will set up a company, and this company will construct the project. So even though DLF is the one which is constructing the project, in paper, it won't be DLF. It will be something like DLF Sector 49 Limited, or DLF Gurgaon Limited, DLF Bangalore Limited, DLF OMR Limited, something like that. They will have the names. And these guys will construct these apartment, right? So here again, where funding, I mean, what is about project finance? We're talking about project right now. What are the business models? In real estate, the evolving business model, not evolving, it's evolved it started in 2005. Since then, it's evolved significantly by now. What typically happens is this: a construction company sets up a project, and in these projects, somebody else comes and gives the money. Also, I mean, somebody else also invests the money, and this money is invested in project. And just to give you an idea, where I was telling you earlier, EPC, E, P, and C may be done by 3 different people. A lot of time in these projects, that's what could happen, because DLF is the one which is going to sponsor. So who is bringing the people and the machine and everything could be L&T. L&T does the procurement and construction, right? DLF made the plan for the project. They went to the government to get the approval, and DLF will pay L&T on a work done basis. So for L&T, this is like EPC contract. It's an EPC contract as far as L&T is concerned. They'll construct the project. As and when they finish part of the work, they'll get paid by DLF for that. And this is how it will happen. Clear? Any questions? Okay. Now, with this discussion, so we've talked about what is a project. That is the first part. What is a project? What are the various business models for the project? I will briefly touch upon the concept of funding the projects. Now, as I said, why do we, I'll talk about this SPVs and everything in detail shortly. What are the challenges in funding for the project? If you think about that, just one second, let me just. See, think about this project for construction, right? Or a highway road. We said there are 2 stages here. Stage 1 is construction risk. I mean, you have to finish the construction. And stage 2 is operation, right? Now, as a bank, when I give a loan for this project, at this juncture, there are 2 risks. I don't know whether you will finish the construction, and I don't know whether you will be able to successfully operate that place. Both of them are unknown for me, right? I have 2 risks, which means very high risk. Now, let's say the construction is done now, right? Construction has been completed. Now I'm here. One of the risk has been removed, correct? But a bank gives you a loan for one long-term loan. They may give you, let's say this is for 5 years and this is for another 5 years. They're giving you a 10-year loan. So if I'm going to give you a 10-year loan and I'm going to price it at this juncture, if I price the loan at this juncture, by pricing, I'm talking about setting the interest rate. If I set the interest rate at this juncture, I'm going to look at this project as an extremely risky project. And being extremely risky, I may want to charge you 20% interest. But as a company, you would not, maybe at this juncture, the 20% is justified. But once the construction is done, at this juncture, you may not want to pay 20%. Because now construction is done, right? Road is ready. So the risk that we talked about earlier is now in the past. That risk is no more existence, is no more there. So why would you want to pay 20% even now, at this time, 5 years later? You wouldn't want to pay it, right? So if you go to a bank and ask for 10% interest, bank will not say agree to it, because for the bank, there's a huge risk. But if you agree for a 20% interest, Problem is you will have to pay the 20% interest even after the project is done, when the risk of it has come down. Maybe in 1 or 2 years, you may even realize that the project is highly successful. It's like a Mumbai airport. People are just, so many people are regularly taking the airport. No risk whatsoever, right? Or maybe a Bandra Sea-Link, anything, or a OMR. Whatever it is, there are lots of people taking it. It's absolutely safe. So question is going to be about, what should I do about this? So this is one challenge. How do I fund it? Okay. Another thing that comes is, let's look at it in a real estate context like this. Now, when a DLF does the construction, Blackstone is not a construction company. Blackstone is a private equity company. Blackstone invests money. That's all they do. Now, they are dependent on DLF to run the project. One of the things about Blackstone, for Blackstone, I'm using the word Blackstone. There could be any private equity player, but Blackstone is a big name in real estate circle, right, among the investors. Now, the thing with Blackstone is, if Blackstone is going to give the money, and Blackstone has no control over the project, because who is going to control the project? DLF. Then they are at the mercy of DLF. So they would like to have a terms and conditions here that kind of protects their interest, because DLF may do something that benefits them, but not Blackstone, right? So there are sometimes things may happen that way. So Blackstone would like to make sure that, they structure the contract in such a way that they could also make some good money out of it, right? That their interests are kind of aligned. So these are all the challenges that we would typically face in a project finance context. Clear? Any questions? Any thoughts? Okay. Now, having understood this, let's go and talk about the second thing, which is how are project finance structured? Why do we do it? And who are the various players here, right? Probably I'll also spend a little bit time on funding and structuring as well today, but maybe not too much. We will be spending additional time on it later. So let me just come here. So now let's talk about the funding side of things as far as projects are concerned. So when we talk about structure of a project, if you look at, let us say, let me take an example of, let's say, Mangalore Airport. So Mangalore Airport is now being developed by Adani Group, right? So let's pretend this is an airport and there's a runway. Now, who constructs this airport? If you think of it, this airport is being constructed by Adani Group. That is in name. But in reality, if you look, that is in reality, but in paper, if you look at it, it won't be Adani. They will set up a separate company for this. Again, I don't know the name that they've used here. For Mumbai, it was a Mumbai International Airport Limited, MIAL, they set up the company name. So here they may set up a company like Mangalore Airport Limited. They may set up a name like this, right? Bangalore also is called as BIAL, right? So you may have a Adani Group, and an Adani may give money to Mangalore Airport Limited, and Mangalore Airport is the one that will be constructing the airport. Why do they do it this way, right? Why can't Adani Group do it themselves? Why are they setting up this company? There are quite a few reasons for it. Any idea what are the reasons? Anybody who can guess? Because I'm talking for a long time. Anyone who would like to share? What's your thought? Why are they setting up this company? There are quite a few reasons. Let's talk about it. For many people involved, not really tax incentives, not as much as tax incentives. So one of the thing is, let us say if the some of these have gone now. Some of these advantages I'm going to talk about now are gone, but let's just try to understand what these are gone in Indian context at least, because let's talk about this. Let us say if this project requires, yes, that's right, it's for ring fencing the cash flows. So let's talk about this. Now, let's say this project requires 10,000 crores. Right? Now, if the entire 10,000 crores comes out of Adani Enterprise pocket or Adani Ports pocket, what if the project is a flop? As I told you, government is not going to pay a single rupee. These are all considered on a boot basis or ham model or something, right? So if it's on a boot basis, I'm going to construct the airport. If the airport turns out to be a flop, I'm not going to make a single rupee out of this, right? Now, therefore, I don't want to pay full 10,000 out of my pocket. So what they would do is, I'll not even put Adani here. First, let me put equity shareholder, right? There are going to be equity shareholders. These equity shareholders, what they would do is, perhaps they are going to invest around maybe 6,000 crores or 4,000 crores they'll invest. Another 6,000, they may go to a bank. It could be a bank, it could be a World Bank, multilateral institutions. A lot of people are there who will give loan. Again, we'll learn that next week, who are depending upon the role of the project. So I go to a bank to get the 6,000. So 4,000 plus 6,000 put together, 10,000 goes into the project. Now, one of the thing is, even this 4,000 may not fully come from the pocket of Adani Enterprise. Why is it? Because one of the things is, as I told you, the core competency could be different. Let's say as an Adani Enterprise, I am good at engineering an airport, right? I'm good at engineering, I'm good at other things, but maybe I don't have construction experience or I don't have project management experience. So I would like to see somebody else in that place. So what you will notice is, so if you look at Mumbai airport, because Mumbai I knew who are all involved much better than Mangalore. So in Mumbai, if you look at it, you had somebody like a Bidwest and then airport company South Africa. They partnered with somebody like a GVK. So what may happen is, an Adani may come and say, you know what, out of this equity shareholders group, 200 is going to come from Adani. I mean, 50%, 2,000 will come from them, Adani Enterprise. Now, there could be some people who are involved in, maybe just for the sake of discussion, let's say think of it this way. I won the bid from the government. I'm going to construct the airport, but I have no idea how to operate an airport, right? I don't know how to operate the airport because I've never operated an airport. So I need somebody else to come and help me out. So there is going to be an airport operator who is going to run the operations of the airport. Now, the thing about the airport operator is, I'll pay that operator for operating the airport, right? Whatever it involves. But I still want to keep in mind that, you know, the operator is taking care of the airport in the best interest of the owners of the company, right? Very simply think of this way. To give you a very simpler example, let us say if I have considered an airport and I'm giving the toll operation to somebody. Now, one thing the toll operator may do is just keep the door open, right? Keep the gate open and let the vehicles pass and just keep sleeping, right? Because if the toll collection is not happening, the loss is for the road company, not for the operator, correct? So I don't want the toll operator to do that. I want the toll operator to have skin in the game. How do I make them have skin in the game? I'm going to bring them as a shareholder. So I may tell them, you know what, you have to bring in another 1,000 crores. This could be an operator here. There could be a construction company, right? There could be, as I told you, real estate, you think DLF is doing the project? Only for namesake, I mean, DLF is the sponsorer. So DLF is setting up the project, it's giving the money and everything. But actual construction company is a Shapurji, Palanji, or is it's a L&T. Some of them are doing it, right? So I may also have similarly, a construction company could be there, a contractor. They may come in and put some money, right? Maybe this guy is giving 500 crores as a shareholder. This guy is putting another 500 as a shareholder. So we want all these people to come and give the equity, right? So we want these people to come and give the equity for us, so that I'm just using a different color here, right? We want these people to come and give us the equity. What is the balance 1,000 out of 4,000? So in a PPP project, sometimes we also have, not sometimes, of pretty much every time, you will have a public authority coming in here. So a lot of airport projects, you will see Airport Authority of India will be a shareholder, right? So they would like to be a shareholder. Because at the end of the day, this is a public project. So public would like to have some say in the business. So these guys would pump in another 500 crores. So this is how the 4,000 is going to come, right? Is it making sense? Any questions? Now, next thing, in terms of the SPV, we're talking about SPV, why we set up the SPV. But so if you look at it, again, I don't have the actual data of Mangalore Airport. What I'm giving you is illustrative in nature. So if you look at it, this project will be called as Adani International Airport or whatever, Adani Mangalore International Airport, whatever. But they are not putting all the money. They're putting 2,000 crores, right? Now, why else are they doing it this way? Now, just let's look at the beauty of this arrangement, in theory at least. It's changed now, but in theory, let's look at it. Let us say this airport turned out to be a mega success, right? Yeah, Adani is the sponsor for Mangalore, but I'm just thinking, I don't know how much capital they invested, who are the operators, I don't have that data. Now, right? Now, what is going to happen in this case is, let's say the project is a mega success, right? And over a period of next several years that they were operating this project, they got back something like 50,000 crores, right? Let's say they got back 50,000 back. Now, out of the 50,000, how much will the bank be paid? They will be paid principal plus interest, correct? 6,000 plus interest will be paid to them in return. So what is available? Maybe something like 40,000 crores is available. And who gets that 40,000 crores? These shareholders. So Adani would probably get for 40,000 on money has gone 10 times. 4,000 has become 40,000. Your money has gone 10 times, which means these guys will be taking home 20,000. Right? Even if this was only, let's say it's not that big a success, it gave them 20,000 rupees. Let's say this project turned out 20,000. Right? This project gave 20,000. Now 6,000 plus interest, I gave 6,000 to these people. Balance 10,000 goes to the shareholders, which means 2.5 times. Your money has gone 2.5 times. So in place of 2,000 I invested, I got back 5,000. Very handsome returns that I could get. On the other hand, let's say this project was a mega flop. Basically, it didn't even take off. I couldn't even finish the project. Right? I couldn't finish the project. Somebody filed some case against the entire project. And that's it. The project was not done. Mangalore Airport remains the same old airport it was. No modernification, nothing happened. Right? People said, we don't want modernification. We are happy with protecting the environment. Right? Now, I have spent some money here. I have spent some money. Now the project is a flop. Or let's say I spent 10,000 crores. But right after spending 10,000 crores, if you think of Mangalore Airport, a lot of traffic there goes towards Middle East. And let's say something changes in the Middle East political scenario. Now we are not flying to Middle East. Mangalore Airport is a flop. Let's say the international airport is a flop. Let's say, just for the sake of discussion. Right? And that being the case, not much money is coming. Let us say we spent 10,000 crores. We got back 3,000 crores. Now what happens? 3,000 is all the project could fetch. Now we would have to pay the 3,000 to the bank because we have taken the loan. Now What happens to the balance money? Where will the balance money come from? Because 10,000 was spent on the project and the project gave 3,000 rupees to Mangalore. Where will the balance money come from? It can't come from anywhere. Money is gone, right? Bank will have to take the loss. As it is, I didn't tell you what else is going to happen. Basically Mangalore airport is going to file for bankruptcy. They'll say, we are bankrupt. We don't have money. They may tell the bank that, if you want, take this airport and run this airport yourself, or give it to somebody else and collect money from that person, because, we can't do that, right? So essentially Mangalore airport has gone bankrupt. This company has gone bankrupt. Can the bank go to the owners and ask them to pay the money? They cannot ask, because in corporate law, we have a concept called limited liability, which means if the company has to pay a money, it is the company's problem to pay the money, not the shareholder of the company's problem, right? In this case, even if it is a with recourse, unless there's a guarantee involved. If it's a guarantee involved, they can do, because the loan has been given to Mangalore airport, right? Loan has been given to Mangalore airport. So unless there's a guarantee involved, I cannot go and touch the shareholders, because the company is a separate legal entity. The loan was given to the company. It is the company's problem to repay back. If company cannot repay, file case against the company, make the company go bankrupt. But the thing is here. So bank suffers 3,000 loss. How much will the shareholders get? They'll get zero. They'll get not a single rupee back. But if you look at it, the loss for Adani Enterprises is only 2,000 crores here. If the project is successful, that 2,000 is becoming 5,000 or 10,000 or 20,000. They have a very huge upside limit. But downside, my 2,000 could be gone, right? So we call it as a ring fencing. So the loss that is there, that is restricted to this 2,000 crores. I am not going to be suffering more loss than that, right? But when the money comes back, I could even get 20,000 crores if the project turns out to be a big success. Clear? Any questions? All right. Now, having discussed this part, how things have changed now. One of the things that it has changed is banks have started insisting on guarantee, right? Why will bank fund any SPV? I'll talk about that next week when I go to funding structures, right? But now to give you a very brief answer, typically in India, these PPP projects are structured. For a PPP project, banks give loan. Typically, which are the banks that give loan? They are all nationalized banks. You will not see private sector banks giving loan for PPP projects. And in a nationalized bank, why they give the loan? Their thinking is that, this is a government project. Nationalized bank is a government bank. Government is behind everything. Government will not let things go bad. It is with that thought process they give the loan. Private banks don't give loan for this that easily. But what about BOOT projects, where we talk about a VATech setting up a separate thing or a DLF setting up a special purpose vehicle? These are all called as, I didn't use the term probably, I didn't describe the term. This entity will be called a special purpose vehicle or SPV. What that means is they have no business to do other than hold this airport and run this airport, right? So in private sector projects, it works, the funding is complicated. I'll explain that when we talk about funding structures. Okay. So these days, one of the things that's happened is banks have started insisting on guarantee from the owners. But banks themselves insist on setting up the SPV. Can you tell me why? Or any idea why banks insist on setting up the SPV? Banks themselves say, set up a SPV. We'll give loan to the SPV, not to Adani Enterprise. But Adani Enterprise should guarantee the loan. Why do they do it that way? The reason is, typically a bank, when it gives a loan, banks would generally insist on cash flow waterfalls. What is a cash flow waterfall? Just to give you a broad idea. So when the construction is happening, right? When the construction is happening, first it will be the equity that will be used. So if I'm just to give you a, metaphorically speaking, when you're constructing it, initially you spend equity to build the first part of the project, right? You put your equity amount and you construct the project. Once equity is exhausted, right? Let's say I'm constructing a big residential project or some other building I'm constructing. You first put your equity, you build it. Once this is built, then maybe there's some other investor who comes in, some other person who comes in and says, I will fund you through bonds or debentures. Then we call it as a subordinate source. Their money will be used for the balance. So while constructing, you're going to use subordinate source to construct. And after that, bank comes and gives the money. Right? So let's say I'm constructing a real estate project. Here is where bank will come and give. Right? So 50% was for equity holders, 25% was subordinate, and bank gives 25% loan. Now this project is, let's say, giving me cash flows. This project, I'm getting rents. I'm getting dollars, money from this project. Now what will happen among the money that I'm getting from the project? Okay, what is a subordinate source? I use the term here. I was going to explain it later, but since I use the term, I'll explain it here. What is a subordinate source? Very simply put, think of this. Let's say I took a loan of 100 rupees from two of you. I took 200 rupees loan. When both of you come back to get the money from me, I have only 120 left with me. Right? I don't have money to pay you both. Now, question is, so you're going to get only 120. There's no way I'm going to be able to pay you anything more. That's all I have left. I have nothing else with me. Now, question is, how do I pay this 120? Do I split it 60-60 to both of you? Or do I pay off 100 rupees to one person and pay 20 to the other person? That depends on senior subordinate structure. If we say it's a pari passu charge or pari passu, that means equal rights. In that case, I will, you gave 100, the other person gave 100, I'll give both of you 60 rupees. That's it. So you both have to suffer 40 rupee loss. If one person has a senior loan and another person has subordinate loan, this is something we would have agreed at the time of giving the loan, that you are senior to all other loans and the other person has said that you're subordinate to the senior person. In that case, I'll have to first pay you first the 100 and the balance 20 goes to the subordinate, which means you are being a senior lender, you have relatively less risk. Even after I lost 40% of the money, you still got your money back. And other person lost their money, a bigger chunk. So that's what we call a subordinate loan. Subordinate loans are those which rank lower in the hierarchy of cash flow payments. Clear? So now what is going to happen is, in the flow of things, once this flat, let's say, starts giving us some money, once the flat starts giving the money, let's say I'm collecting rent from here. What we'll have to do is this money will have to be first used to pay the bankers, right? First you pay the bankers. Whatever is their kitty, you have to fill that kitty. Once that kitty is filled, if there is more money coming in, that money will go to pay the subordinate holders. Right? Any excess money will go into this kitty. Once the subordinate holders are paid, the balance can go to equity holders. Of course, there are quite a few other things also, project affected people, operation reserves, etc. A lot of things come. I'll talk about that later. Right? So the balance money can go to the equity kitty. So which means the dividend that I'm paying to my shareholder cannot be paid unless the bankers are paid, unless the subordinate debt is paid. Okay, a follow-up question is, who are the subordinate lenders? It can be anybody, right? Anybody who agrees to be a subordinate lender. Now, what a subordinate lender will get is, will get a higher return. If bank is getting 12% return interest, the subordinate lender will get 15% interest, right? I shouldn't say will, may get 15% interest. So why are they willing to accept the subordinate position? Because we are paying them better interest rates, right? And these are mostly used when it comes to public-private projects. Okay. Sorry, in private sector projects. In public projects in India, as I said, banks end up giving you a lot of money themselves. So this is what happens, right? This is the waterfall structure. Now the question is, how will the bank keep an eye on the waterfall structure? Because how do I ensure that the money coming from this building that you constructed by taking loan from me is not getting used for any other purpose, that it is not being paid to the shareholder? Because if, for example, if a DLF takes a loan for constructing a mall and they already own 40 malls and DLF pays a big dividend to the shareholder, bank may go and ask them, how did you pay dividend to the shareholder? And DLF will say, oh, don't worry, that's not coming from your mall. The mall that you funded, that money is coming from another mall that I own, right? Now that could be a pretty tricky thing for a DLF. I mean, for a banker to tackle, because I'm going to say, no, this money from the flat is still given to you. We are not giving to anybody else. What I paid was some other money from some other flat. So therefore, what banks insist is, banks kind of tell them that, you know what, any such projects set it up as a SPV. Because only when you set it up as a SPV, I can monitor it. Because if the money comes to the SPV, this SPV doesn't have any other source of income. There is no way it can pay a dividend and say that is coming from another airport. Because another airport is not owned by you, right? You only own a Mangalore airport. So if you are paying any money from your account, if you're transferring it to the Adani account, that means you are breaching the terms and conditions. There is no other explanation, right? Before paying me, if you paid them anything, you are breaching the terms and conditions. So this helps the bank have better monitoring of this entire thing. Clear? Any questions? Yeah. So as I said, I didn't talk about the debt reserve, escrow accounts and stuff. We will talk about that when we go a little further in detail. Okay. What we'll do is, I actually thought 15 minutes back, I thought let's take a small 5 minutes break because I just went on for 1.5 hours in one go. Maybe let's just take a small 5 minutes break. And once we come back, we'll talk about a few more things. I'll also throw to you some practical jugaad that, companies do, what they do, etc. We'll talk about that. So we'll probably take a small break and then we'll continue. Okay. So shall we start? Yeah. Okay, great. So what we have discussed so far is in terms of, what is a project finance. When we say project finance, what are we talking about it? What are the kind of challenges we face? And how project finance works in the PPP space, how it works in the private market. We talked about it. Now we've talked about the concept of special purpose vehicle, what these are. We have talked about them. Now let's go and talk about briefly about, who are the players who are there in project finance. Sponsors, developers, operators, contractors. Who are these people? Who are involved in these things, and what kind of investors do you get in project finance? We will also talk about this. So if you look at a typical PPP project, the person who is going to be involved here is the government, right? So if it's a PPP project, I will have a government which is going to sponsor the project. Government will say, no, I am initiating this road, because before government initiating the road, if government doesn't say, let's construct a toll road, you can't go and say, I'll do it myself and collect toll charges. Government has to initiate it. So you are going to have the government, who is one person. Then we are going to talk about who is the one who's winning the bid. Now, I didn't talk to you about how the bids are selected for, let us say, a boot contract or anything. I'll briefly also talk about that. See, if it's a bridge that has to be constructed and you go to municipality, where municipality is going to pay you, typically on what basis will they select? Of course, they will look for qualification. Are you competent enough? Have you done a similar project in the past? They look for all those things. But besides that, if they are going to give you, on what basis will they give it to you? Financially, what factor they look at? Whoever is asking for the lowest price. In a boot contract, government doesn't pay anything, right? Government doesn't pay anything. And when government doesn't pay anything, on what basis will I select who's the lowest price? Because I'm not going to pay anybody. I'm literally paying zero to everyone. So on what basis am I going to select anyone? One way, if you look at it, the basis in which we select them is based on what we call as viability gap funding. What is this viability gap funding? So while in a boot contract, we are talking about, and this is also just to give you an idea in terms of, in a PPP space, at least in the PPP space, in the public-private space, what is the overall framework, how things happen, right? So what would happen is, if government has to set up a project, what government is going to do is it will hire some consultancy firms and others. They'll say, what we are considering setting up, let's say, a road from connecting Delhi to Kolkata, going via Agra, Lucknow and Kanpur, right? I really don't know the route. I'm probably, some of the routes come in a different order. I'm just giving you. So they may say, we are going to conduct this central government project, or a state government project may come and say, we want to connect Agra to Kanpur via Lucknow. We want to construct a road. So first they would hire a project consultant, right, who will help them trying to understand what are the benefits of this. Is there a need for such a role? And if because of this, what benefits can come and how much cash flows can be expected? If somebody starts this project, if anybody picks up this project, what is the amount that they can expect to get out of this? These are all, that is something that they will look at. Then they will float the bid. They'll say, this is what our consultants are, this is our project study. This is what our project study says. Now you guys come for a bid, right? Who are all interested? Give me an expression of interest. Now at that junction, what is going to happen is, I may think that, I would like to construct this road. I would like to collect the toll, but I think it's financially not feasible, right? If it's not financially feasible, then what I'm going to do is I'm going to ask for, let us say, a VGF. VGF stands for Viability Gap Funding. This is the money that I am asking the government to give me, right? I am asking the government to give me a money saying that this project is not financially feasible, but if you give us some amount as viability gap funding, right, then we will take up this project. So government will basically look for, among other factors, they will look for who's asking for the lowest VGF, right? And just to give you an idea, in these projects, you also have a concept of negative VGF. What is a negative VGF? Because what if, let's say, the project is financially viable? It's a highly viable project. If it's a highly viable project, then the question is, nobody wants a VGF. Then how do I select? Then the plate is reversed. These companies will have to pay the government. They will be saying that, you know what, you don't have to give us anything. Give the project to us and we will give you 10 crores. We will give you 100 crores, right? You give the project to us. Legally, by the way, right? We will pay to the account of state government or central government. We'll give you 100 crores. You give the project to us. That is another approach here, right? So they will look at, you know, who's asking for the lowest VGF. If nobody wants viability gap funding, who is willing to give the government the money? And that is how government is going to select these players. So now talking about the players involved. So we said, you know, one is government. That's the person who's going to initiate it. Then comes a sponsor. Basically, this is the guy who wins the contract, right? I've got the contract. So there is a metro rail to be started and Reliance Infrastructure wins the contract. So these are the guys. Questions, does negative VGF contract exist? Very much. They exist a lot, right? There are a lot of negative VGF projects. Especially it happens, you know, negative VGF, where I have seen personally, not in the infrastructure side, but on the residential side I have seen. So what may happen is tomorrow somebody may say, you know what, we want to redevelop this slum, right? Redevelop the slum. So for the slum dwellers, give them some house and you develop the slum into a residential area and sell it off, right? For them, give a proper house. And once you sell that proper house, then you can, balance can be sold off to other investors. And in certain areas where real estate is like a hot cake, these people go and say, okay, you know what, I'll give the slum dwellers their house and I will construct the flat and I'll sell it off. And I will also give government some money, right? I will pay the government, I will pay the slum dwellers and you give me the land. That's it, right? I will use it. So those things happen a lot. Okay. I have not seen it in infrastructure, but it doesn't mean it doesn't exist. It's just that I have not come across one. In real estate, I've come across quite a lot. So now coming back to this, so you have a sponsor. Now, the sponsor is the one who is going to put the initial capital and set up the SPV, right? So in the Adani Enterprise Mangalore Airport example, this is going to be the Adanis, right? They are going to put the monies, Adani Enterprise, they're going to set up the SPV. Then we are going to talk about who else? We are going to talk about contractors. The contractor basically is the person. So as I told you, Adani has won the right to construct the airport. Doesn't mean they are the one who are actually going to construct it. They may give the task to a L&T. They may give a task to somebody else. Now these people are going to come and do the construction. So the contractors are basically vendors. They are vendors to the project, right? But as a vendor, when I'm hiring this vendor, what I may want to do is, I may not want to take the vendor right away. I want to make the vendor have skin in the game. So this guy is giving me a service of, as a contractor, he's taking up some contract work in the project. He's probably building some section of the airport or doing some interior decoration, whatever. This person has been given some part of the work is being done as a contract, subcontract, if I may say, because government gave me the contract and I gave some of that work to this guy. Now, this person, in order to have skin in the game, while this person is a vendor to me, I would ask this person to invest in capital, right? So that is the contractor. This person is going to be paid by the firm for the service. Whatever service they render, we'll pay them, but we will ask them to invest capital also so that they have skin in the game. Same way, we are also going to have operators. Operators are also vendors, right? As I told you, somebody has to run the operation of the airport because build, own, operate, and transfer. So I'm an infra company. I know to build. I don't know to operate. So I need somebody to help me with the operation. So I need an operator here. The operator is again a vendor. The operator will be paid by the project, right? The project will pay this person some fees for the service. But this person will also be investing in capital. Some equity capital will be invested by this person, right? So operators and contractors are ideally vendors, but we may, the sponsor may ask them to, as a precondition to accept them, the sponsor may ask them to pay some money in this. Clear? Any questions? Okay. Then we have the developers who are basically, I mean, it's the sponsor may themselves act as developers also, right? We also have one more person in the PPP, which is the, as I told you, some public authority. In a PPP contract, they may come into picture. They may also invest as shareholders. Now, typically, if you look at the public authorities, they hold 26% share capital. So, Airport Authority of India, if an airport is constructed, they own 26%. Can anyone tell me what is the significance of the 26%? So typically the sponsor will own around 50%. This guy will own 26%. It could be 50 or more than 50. The contracts and operators will own extra. Why 26%? If it's voting rights, everything gives me a voting right. If I own 5 shares, I have 5% voting rights. If I have 40 shares, if I have 20%, I have 20% voting rights. Why 26%? Why not 24%? Why not 49%? More importantly, if you think of it, certain significant decisions in a company's life, if you have to take it, that requires special resolution. Special resolution is 75% voting rights. So for example, if you want to sell your company, if you want to sell your business, I'm going to sell this company, I'm going to do a divestiture, that requires a special resolution, and special resolution requires 75% voting rights. Now, at the end of the day, keep in mind, government doesn't want to invest money here. So government can say, if government wants to have full control, government could put all the money and government can do the project itself. Government doesn't want to do it. It doesn't want to put the money here, right? It wants to put as less as possible. But at the same juncture, it doesn't want to give sweeping powers to these private players. Then one fine day, they may sell the airport to somebody else, right? Now, if you're going to sell the airport, transfer it to somebody else. So if a GVK wants to sell it to a Adani for a Mumbai airport, Airport Authority of India would say, at least take my permission, right? If there's going to be a divestment. So for that reason, they take 26%. Anything more than 26% means government has to pay more, which government doesn't want to do. Anything less than 26%, then these guys can pass a special resolution and government will have no say in the business. That is why. Clear? So these are all the various shareholders who give money to these projects. Now, actually, I told you that I'll give you a small tidbits about what happens and why the guarantee concept came. When I talk about lenders, I'll come to it. When you talk about lenders, who are the people who give money to these projects? See, when you talk about investors, in addition to that, you may also have in private projects, especially in the real estate space and all, you may also have other equity investors. These are pure financial investors, right? So if you look at sponsor, they are strategic players. They have invested money. They are going to run the business. Contractor, has invested the money. Contractor is going to run the business. Operators, everybody. Then you may have some equity investors. I generally don't see that in the PPP space, but in other projects, you may have them. Equity investors who come and give the money here, right? They invest in these projects. Now, what is the idea of equity investor? Equity investor has no role to play in the business. Equity investor idea is I will give money, and after giving the money, I will, I'll give the money and I will just earn the rewards for the money. Right? That is all the idea of an equity investor is. Just give me one moment. So sorry, just somebody at the door. Just one second. Sorry, I'm back. So talking about equity investors, these are basically people who invest money into these projects, and their idea of investing money is they're not part of the business. They don't have any single say in the business. Their idea is to collect this money. So what kind of people would you find here? There are private equity firms, right? You may have PE firms. And in Indian context, very recently, one of the things that India has started, maybe it exists in other parts of the world for a longer time, InvITs. Do we know about InvITs? What are InvITs? InvITs stand for Infrastructure Investment Trust, right? Why did the V come? I really don't know, right? These are infrastructure investment trusts. So the idea of infrastructure investment trust is you can think of them like a mutual fund, right? You can think of them like a mutual fund. A mutual fund takes money from public and invests that in stock market, right? And they give the returns to you. What an InvIT does is they take money from public, and this money is generally invested in infrastructure projects. So they may give money, put their money in an infrastructure project, and that is the InvIT side, right? So these are all equity investors. Typically, if you talk about, in projects, who are the kind of private equity, pure financial investors who come in? It could be InvIT. It could be a private equity firm. Now, one question I've got here is, are private equity firms LLP? See, LLP stands for Limited Liability Partnership, right? Now, a private equity firm can be structured as a LLP. It's a very common thing, at least in US and all. But a private equity firm can also be a limited company as well. Nothing stops them from being a company. There are private equity firms which are structured as a company as well. But a lot of private equity firms is LLP, Limited Liability Partnerships. That suits how they collect. So that is more to do with how the private equity is organized, how they collect money from their investors. That is where whether it should be an LLP or a company kind of affects them. But that is not very relevant for us in this context. So PE firms are private equity firms, and they may also be investing in these projects if they think these projects have good return potential, etc. for them. As said, in Indian context, I have not seen PE firms in infrastructure projects, but they do have they put money in real estate projects. Clear? So now, these are all the players that we have. Now let's talk about lenders. Who are the people who lend to this particular projects? Now, if you talk about lenders in the infrastructure space in Indian context, typically you only have banks or multilateral institutions. What are multilateral institutions? Multilateral basically means organizations that are funded by or that are kind of multi-country kind of organizations, right? So you can think of Asian Development Bank, World Bank, right? These are all examples of multilateral institutions. World Bank is called as IBRD, International Bank for Reconstruction and Development, right? BRICS Bank. So basically these are all organizations that are set up by multiple countries coming together to help each other out. So these multilateral institutions, typically they fund development projects. So you cannot go to a multilateral bank to get money for a real estate project because that is not a development project, but they can give you money for setting up a dam, right? If I'm constructing, a government has given a hydropower plant on boot basis. So you have to construct the dam yourself and you have to collect the money. You have to produce electricity, sell it and collect the money. That is your job. Since it's a development project, you can go to a World Bank and World Bank will be able to give you the loan. But so you have to qualify. Does your project qualify as a development project? Then you can go to multilateral institutions. A lot of highways, waterways, airports, dams, everything will qualify for multilateral institutions. So you can go to them for getting the loan. Or you could go to nationalized banks. You can go to them for loans. Another one that I talk about, which is available in Indian context, it's not used a lot, is bond market. You could go to the bond market and take money from the bond market. But if you're going to the bond market, who will invest there? Again, the Innovates guy can invest in the bond markets as well. They can invest in equity, they can invest in bond. Public can invest in those markets, but it is not very commonly followed. Sorry, I just got a question. CP, what do you mean by CP? Commercial papers are short-term instruments. We are not going to use them for commercial papers are not going to be used for long-term projects. They are, because commercial papers typically have a very short shelf life, and these projects require long-term loans. So we won't go there, but yeah, we can go for bond markets to get the money, right? So these are all options that are available as a lender, right? Now, just to give you and I think I've already completed what we had on agenda for the first 2 hours. But one of the things I told you was just to give you a small tidbits on what has been happening, what some unscrupulous sponsor companies do, and why banks started insisting on guarantee. I said, the idea of setting up a special purpose vehicle was to ring fence the cash flows, right? That when I set up a SPV, these are all, one of the players is the SPV, of course. I didn't explain that, right? One of the player is the special purpose vehicle, right? Which is being set up by these, because theoretically it is also a legal entity. And I discussed earlier, why do we have the SPV? We have the SPV so that we could do a ring fencing of the cash flows. But in Indian context, something started happening. And again, these are all something we can only speculate because no investigation has proved anything conclusively. But because of these things, banks have started asking for the sponsor to give guarantee for the loans. What happened? See, I told you that there's a waterfall that happens, right? By waterfall, what we're talking about is, so profit of SPV will have to be first used towards, there is a order in which this money can go. This money cannot directly go to the equity holder. This money should first go towards meeting my operating expenses. Then if any money is left, that should go towards, we even talk about rehabilitation. In fact, now relief and rehabilitation In the sequence they have changed it. It has to happen first. But basically, relief and rehabilitation of project affected people. If you're constructing dam, villages are going to get submerged and those villages have to be moved to somewhere else. So they have to be paid. Then we are talking about lenders. Then equity holders, right? This is how the money should go. Revenue, I'll put it as revenue of SPV. Now, what some of the equity holders started doing was, or at least speculation, right? This is a doubt or serious things that have started raising, is that obviously OPEX takes priority. So it's the profit that gets paid to the lender, right? And I am going to bring in my favorite vendor here. So the OPEX money, which is going here, actually speaking, goes towards a favorite vendor, inflated bills. So I'm going to get one of my preferred vendor as, so for example, I need a road roller. Let's say a road roller rent is, typically you can get it for 1 lakh rupees a day. I am going to get my favorite vendor here who is going to bill me 3 lakhs per day for one road roller. And this vendor gets the money, right? This vendor gets a 3 lakh. This is a preferred vendor. And what I am going to do is I'm going to give some service to this guy. Service which will only be in paper. I'll say, no, I'll give the consulting services to this guy. I'll help them do this. And I'll get 2 lakhs from this person or 1,90,000. So what we're going to make it look like is we're going to look like money did not go to the equity holder, right? But the project is loss making. And why is it loss making? So nothing happened. We didn't do relief and rehabilitation. We didn't pay the lender. And why is it loss making? Because huge expenditure. And who gets the actual expenditure money goes to whose pocket? The equity holder's pocket through the use of inflated bills, right? So government did one thing about R&R. So what they did about R&R is they said, you know what? We are going to move the R&R towards CapEx expenses. So we're going to say, even before you start your project. So if you're doing, for example, a slum clearance project, your first job is, before you could sell the first unit, first give these people alternate accommodation, right? You're clearing your slums. So whoever has to be displaced, for whoever you have to give alternate accommodation, give them that alternate accommodation. Once you give that alternate accommodation, then you go ahead and build this thing. So it's like cost of land. You don't pay for the land because it's a slum area, right? Government is giving it to you. You don't pay for the land. Instead, you rehabilitate these people. That is the idea. Only then you can sell it. So that way, at least they have protected the R&R from these unscrupulous practice. But lenders, they are still going to be like, they're going to get affected. So what do lenders do? They said, you know what? You guys as an equity holder, give me guarantee. Because you guys have been doing all these things. So you have taken your money out and my money doesn't get paid and you file for bankruptcy. So lenders went and said, you know what? We will give loans subject to equity holders giving guarantee. Now, I don't know how many people indulge in this kind of practice, whether everybody indulged, whether only few indulged, but banks have now made this into their practice where they ask everybody to give this money. So this is how it works. Okay. Any questions, any thoughts? So this is just, we talked about what is project, what are the kind of questions that arise in funding a project as compared to funding anything else. And we talked about a typical structure of a project, the waterfall structures, how they work. And we learned about the people involved here. Let me know if you have any questions. Okay. Okay. One question is, a couple of questions. Audit must be catching all these acts. Not really. I mean, as an auditor, all I see is a bill, right? Some of them could be caught if there's a special audit arranged. A typical statutory audit will just say, is there a bill involved? There is a bill. A vendor sends a bill. So unless you order a special audit where I go way deeper to figure out whether this bill is a genuine one, whether it's in line with the market prices, etc. A special audit can catch it, but a regular audit cannot catch this. Is it possible to avoid the malpractices? I am not sure. I mean, that's not my core competency. So maybe it is possible, maybe it's not possible. That's not my core competency really. Okay. So in terms of if you're talking about viability study, what do you mean by TEV study? Total economic viability, right? That is what you mean. Yeah. Techno-economic viability. Now, I mean, as such, as I told you, there are two studies happen. I mean, one study that happens at the government level, where the government does that even before they float the idea of a project, float the idea of a tender. They do it at that juncture, right? They're going to say, no, I think we should take up a project. This project will help us. Now let's talk about this thing. Is it economically viable? Is it feasible? Is it feasible to do the project? And will it be economically viable? That is something that they do. Once they do that project, then the company who applies for it, they do this. Now at a lender level, how much they do, I'm not 100% sure. At a lender level, what all kind of study that they do, because these studies are going to be done already at various levels. These studies are going to be done at various levels. Now, as a economic viability study, they definitely do. So, because if I go to a World Bank for a loan, World Bank will build a financial model to try and figure out whether this loan is financially feasible. But whether a World Bank does a technical study, I am not sure about that. Right? I know they do an economic viability study. I'm not very sure if they do a technical viability study. I'll have to check on that. Okay. World Bank or any bank for that matter. You go to any bank, they will do economic viability study. That for sure I know, because I've been a very close part of that in certain cases. But technical study, I have not really seen that. Maybe they do that. Okay. Any other questions? Okay. All right, then we'll catch up next week and we'll take this discussion forward. All right. Thank you. Thank you very much.